One Indian bank just reported a quarter where profit rose 5% and the single most watched number in banking fell 54 basis points in 3 months. Not because lending slowed, not because loans went bad, because of a timing mismatch written into the rules, a mismatch that guarantees the pain arrives before the relief. Here's the mechanism, and why it is entirely predictable. The PF first. A bank's margin is the gap between what its assets earn and what its liabilities cost. Both sides move when the central bank moves. They do not move at the same speed. In India, most floating rate retail and small business loans are contractually tied to an external benchmark and practice the repo rate and must reset on a fixed cycle, typically within a quarter. Deposits have no such rule. A 3-year term deposit signed last year keeps paying last year's rate until it matures. So when the policy rate falls, the earning side of the balance sheet reprices almost immediately, and the paying side reprices slowly, contract by contract, as each deposit rolls over. That gap is the whole story. It is not a judgment about any bank. It is arithmetic on a calendar. Some context tightly. The Monetary Policy Committee held the repo rate at 5.25% at its June 2026 meeting, with a neutral stance. The important word there is held. The cuts that matter for this quarter happened earlier, and by the June quarter most of that transmission had already worked its way through the loan book. Analysts describing the quarter put it plainly. The benefit of deposit repricing only partly offset pressure from lower-yielding corporate loans and still elevated bulk deposit costs. So this is the awkward middle of the cycle, the part where the asset side has fully absorbed the cut and the liability side has not yet caught up. And it is not uniform across banks, which is the useful part. Some banks entered the cut with mostly short-dated deposits and repriced quickly. Others locked in long deposits when rates were high, which felt clever then and expensive now. Same policy, different balance sheets, different outcomes, which raises the question the numbers answer. It also helps to be precise about what a basis point is here, because the numbers look small and are not. A basis point is 1/100th of a percentage point. A bank running a balance sheet of 2 lakh crore rupees of earning assets loses roughly 200 crore rupees of annualized net interest income for every 10 basis points of margin. So a 54 basis point move is not a rounding error in a footnote, it is a material change in the earnings engine, arriving in a single quarter, from a rule change nobody at the bank controls. Now build it block by block. Block 1, the asset side. Under the external benchmark framework, a large share of floating rate loans is linked directly to the repo rate rather than to an internally computed cost of funds. That link was introduced precisely to make transmission fast and visible. It worked. The side effect is that fast transmission is not optional for the bank. When the benchmark moves down, the loan yield follows on the next reset, whether or not funding costs have moved. Block 2, the liability side. A savings account can be repriced by the bank at will, but a term deposit cannot. The rate is fixed for the tenure, so the cost of funds falls only as old deposits mature and are replaced at newer, lower rates. If the average residual maturity of the deposit book is, say, 18 months, then most of the relief arrives over the following 6 quarters, not this one. Block 3, the arithmetic of the gap. Net interest margin is net interest income divided by average earning assets. Push the numerator down through faster asset repricing while the cost side is largely fixed, and the margin compresses even if the balance sheet is growing and credit quality is fine. Now check that against the actual quarter. IDBI Bank reported net interest margin of 3.61%, down 54 basis points quarter-on-quarter and 7 basis points year-on-year, with net profit up 5% to 2,115 crore rupees. Central Bank of India reported margin of 3.06%, down 10 basis points year-on-year, explicitly because the fall in yield on advances was sharper than the decline in the cost of funds. That sentence is the mechanism stated in a press release. And in the same quarter, South Indian Bank reported margin of 3.23%, up 28 basis points sequentially, having clawed back the earlier dip. Free banks, one policy environment, margins moving in opposite directions. Block 4, the amplifier. None of this happens in a vacuum, because banks are also competing for the deposits they need. As of the 15th of June 2026, banking system credit was growing about 17.7% year-on-year while deposits grew about 12%. Pushing the credit-deposit ratio to roughly 83.4%. Read that as a scarcity signal. When loan growth outruns deposit growth, banks bid harder for deposits, which is exactly the wrong moment for deposit costs to fall quickly. The rate cut says funding should get cheaper. The deposit market says not so fast. So who wears it? Start with the banks themselves and be precise about which ones. A bank whose book is heavy in external benchmark-linked floating loans and funded with long-term deposits takes the largest hit. A bank funded mostly with low-cost current and savings accounts takes far less, because a big slice of its funding barely reprices at all. That is why the current and savings account ratio gets so much attention in Indian bank commentary. It is a direct measure of how insulated a bank is from this exact squeeze. Next, borrowers. The same rule that compresses margins is what delivers a lower equated monthly installment to a floating rate home loan borrower quickly rather than eventually. The transmission the borrower experiences as speed is the transmission the bank experiences as compression. They are the same event seen from the two sides of one balance sheet. Then depositors, who face the mirror image. Deposit rates typically follow lending rates down with a lag, so existing term deposits keep paying the old rate for a while. And finally, the policymaker, who has to weigh a real trade-off. Faster transmission is the stated goal of the benchmark rule because it makes monetary policy actually reach the economy. The cost is that bank margins absorb the shock first, and margins are what fund provisioning and capital. Neither observation is a complaint about the design. Both are consequences of it. There is one more group worth naming, because it explains why this shows up in the share price rather than only in the annual report. The analysts who model these banks. Margin is the input almost every bank valuation is most sensitive to. Far more than loan growth, because it flows straight to pre-provision operating profit. So a 54 basis point sequential move gets priced immediately, even in a quarter where reported profit rose. That is exactly what happened in the sessions around these results, when private banking stocks were the biggest drag on the headline indices while the broader market held up. The market was not reacting to the profit line, it was reacting to the margin line, and to what the deposit repricing calendar implies for the quarters after this one. One line to keep. In a rate-cutting cycle, an Indian bank's loan book reprices on the regulator's calendar, and its deposit book reprices on its customer's calendar, and the margin lives in the gap between those two calendars. That is why 3 banks in one quarter reported margins down 54 basis points, down 10, and up 28. Not 3 different economies. 3 different deposit maturity profiles. The forward question worth holding. If external benchmarking makes cuts pass through fast, it also makes hikes pass through fast in the other direction. Margins expand first and compress later. So is the framework making bank earnings more responsive to policy or simply more cyclical? That is a structural question. And the reported margin line each quarter is where you can watch it being answered. For more breakdowns of the machinery under Indian markets, subscribe. Educational content, not financial advice.